I want to go back to the idea of the dollar shortage first, right? Which is, I think, in the macroeconomic world and people who manage money professionally, they really have a good grasp of that. But just spend kind of a minute describing what that means in layman's terms for people who aren't in that seat. And then we can get into kind of some of the knock-on effects and why that's put us in the position that we're in today.
Okay. Simplistically, and again, I would say if you want to go deep, go dig into all the macro voices, guys. Simplistically, dollar shortage, the dollar is the world reserve currency. That means a lot of different things, but it means that countries around the world want to transact in dollars, dollar-based transactions, financial contracts, liabilities, financial instruments. You want to do that in dollars. Because you feel good about the stability of what that's going to be. That creates what is very broadly now been called the Eurodollar market, which is basically all of the dollar-denominated liabilities and financial instruments that exist outside of the United States and thus outside of the direct purview of the Federal Reserve. And when this dollar shortage situation had been, again, going on for a year, close to a year. I mean, I think the macro voices guys would probably tell you it's been going on for like 5 years. If you want to go all the way back to, when, foreign buyers of treasuries stopped becoming net purchasers of treasuries, which I think was in 2014. I know that was a big part of that kind of dollar, how that started. But you fast forward to today and you have a big deleveraging event, a market crash like we had in March, and the whole world was already scrambling, barely getting enough dollars to satisfy these various different, contracts and financial instruments. And then there's this big race for dollars and it's just a vacuum. And the easiest way to think about how big that vacuum was that the Fed and the Treasury and the US government announced north of $7 trillion of monetary and fiscal stimulus from, over about a 6-week period of time in kind of March, April. And the Dixie, the dollar index, which is the US dollar weighted against a basket of international currencies, the Dixie was unchanged over that period of time. So 7 trillion of stimulus. Again, you did like 2 trillion in the financial crisis over a really big, multi-year period of time. And we did 7 trillion in, 6 weeks and nothing happened to the dollar. That's how short the world was dollars. And so the setup that puts in place is, it now puts the United States government in a position to basically be shooting against dollar weakness with record levels of stimulus, unprecedented levels of stimulus. I don't know if you saw this statistic. Goldman put this out in their research about 3 weeks ago. Let me make sure I get this. The disposable personal income in the United States in 2020, Goldman predicts to be 0.5% higher than in 2019. Higher. Basically flat. Let's call it flat. Disposable income flat year over year. How is that possible? That's possible because of the magnitude of the fiscal stimulus the United States is providing right now for people in these unprecedented times. Whether that's the right thing to do or the wrong thing to do is not what we're talking about right now. And it's almost like less interesting, actually. Let's just identify what they're doing. And that's what they're doing. And as long as the dollar is hanging in around here, in my opinion, it's giving the Fed and the Treasury the green light to keep doing more and keep doing more. And that's basically what they're shooting against.